Good morning, America. Hubert Johnson here with Taxes Made Easy. And we have an interesting show today, a little bit off the beaten path, not something that you normally deal with when it comes to tax debt resolution, but something that affects almost all taxpayers or can affect you if you're looking to purchase property. So, this is all about property taxes and how they affect you, how to understand them, and how to make rational decisions because this affects your biggest asset. Most people are striving; they either are homeowners or striving to become homeowners, and build up that equity and long-term investment in their own home. So property taxes affects people all across the country. Very powerful issue, and it's not easy to deal with. It's actually fairly difficult to deal with. So we'll be right back. Welcome back, everybody. Thank you for watching either live on rebroadcast here at the Smart Money channel or smartmoneyculture.tv. And we've got a lot of news to cover, a lot of information, and just wanted to share one thing with you quick. So on IRS news, there's some really interesting things, and I just want to kind of cover this. So I'm going to go ahead and share my screen while we talk about this as well, because believe it or not, there are plenty of times that the IRS is trying to help. So what I'm going to share with you is this is straight from irs.gov. Just type in news releases or IRS news, and so every day it comes out. This is where I get a lot of my information. Some of this could bore you to tears, but this tax time guide that they've been coming out with, and they come out with this yearly, but they've come out with 4 different things this year. So how do you escape penalties and interest with electronic payment options on the irs.gov? As a tax professional, most of the time when the IRS tries something new, it doesn't help. It's a flop. It's a pain. I am excited about irs.gov. Why? Because it allows for taxpayers to get more information, to get a more hands-on approach. Does that mean they can do more things without a tax professional like me? Absolutely. I'm not intimidated by this. I deal with the hard nut problems and issues, and when people aren't familiar with irs.gov, yes, we'll do the simple things too if they need that assistance. But I'm all for people being able to have more information, get things at their fingertips, and long term have a better understanding of what's going on with their tax situation. So today's article came out March 14th, so yesterday, goes into, first of all, there's 4 parts to this. So I want to just click on this. These are the 4 parts that have been put out for 2024. So you have the tax guide for 2023, but then what to know before completing a return. Where's my refund? There's a tool to look at where your refund is and what's happening with it. Again, reporting digital assets, gig economy, income, foreign source income and assets. You need to report all of this. A lot of it's being reported to the IRS, and they'll see that. So, and then today's episode was about escaping penalties and interest with electronic payment options. So that's really what I want to focus today, but I want to share this information with you. Put so you know where to get this information. And are most people checking irs.com or IRS news often? No, but it is a handy source. And especially at the beginning of the year, this is a lot of good information and updates that they can give you. It is from the IRS perspective. So take it with a grain of salt, but some of the stuff can be very helpful. So just some of the things that you can do. You can do the free file for $79,000 or less. Caveat here, there are a lot of concerns about this free file program. One, it's being funded in an interesting manner. it doesn't intimidate me or affect me, but it does hurt a lot of tax preparers. But again, if you have anything more complicated than a W-2, you need to be going to someone that knows what they're talking about. I spoke to someone yesterday, and they have $1.8 million in investments. And they were moving money around and just made some mistakes, didn't know what they were doing, and all of a sudden they're getting hit with $170,000 in taxes, at least. That doesn't include all the accrued interest and penalties, so it's probably going to be more like $200,000. All because they didn't have a financial professional giving them advice and a CPA to help guide them through the process. How should they invest? Where should they move their money around? And so that it's so important. If you have some funds, spend a little to save a lot. And I'm not saying hire me, because I don't do that. I don't prepare taxes. I don't give tax avoidance advice. We're very specialized in that. We just focus on collections. But we can absolutely, we work with those individuals all the time, and we'll refer you to a good tax preparer, CPA, or financial advisor if needed. And again, we have networks where we can refer people all across the country. I've even pulled up information for, last one was a CPA in Guam. That was not easy, by the way. But again, that's what we try to do for people when they call in. And we don't charge for that. So once you set up, excuse me, so you have the free file, anybody making $79,000 or less, make sure it's a simple return, please. As another example, they were using TurboTax, or no? Yeah, she was self-filing through TurboTax, and it's just, can't tell you how many times I've seen people use programs that were too simple, and the problems come later. You can set up an IRS online account, and yes, you have to go and you have to scan your face. So if you have concerns about Big Brother, which are valid, I'm not trying to minimize those. You might not want to do this, but once you get your online account, you can pull up all kinds of information. Prior year AGI, payment history, you can see when they actually receive and process payments. You can pull your transcripts so you can see what your wage and income is as soon as those transcripts are ready. You can get a lot of information that normally you have to go through a tax professional to get, or you have to call and spend hours upon hours trying to get through to the IRS. So payment plan details, digital copies, there's a wealth of information there on irs.gov by using this source. So then payment options. So direct pay, you have, you can pay directly through your bank account. There are fees if you pay with a debit or credit card. So I think it's 2 to 3%. Depends on which vendor you're using. They give you a few different options, and you can go through that. They have a mobile app now, IRS2Go mobile app. But make sure whenever you're making payments, go to irs.gov, click on pay, and go from there. Electronic funds withdrawal, you can pay directly from your bank account. EFTPS, if you're set up for that. This is for companies and people making regular payments to the IRS, such as estimated tax payments. And then you can pay from a debit, credit card, or digital wallet. But again, it goes through that. So I just want to show you real quick. You click on pay, pay now, pay with direct debit, card, or digital wallet. You can sign into your account. You can even set up certain basic installment agreements. So if you owe less than $50,000 or $100,000, if you can get a 180-day hold time on your case. The problem is, if you go in and say, look, I just need time to pay this up. I need time to pay my balance. And you get a 180-day hold time on your case. You're chewing up all the hold time on your entire case. So when we go and we work on a case, we might get 30 days at a time. We'll work on their case, we'll submit the documents, and then we're waiting on the IRS. So we can stretch that 180 days out to a year, year and a half. use it when you truly need it. If you go and you get 180 days hold time at once, then the IRS is not obligated to give you any more hold time if you need it. If you're in a pinch, in an emergency, and you ask for more hold time, if you haven't used that 180 days, you can get it. But if you've blown through that 180 days, I've seen that mistake happen plenty of times, it can really hurt your ability to negotiate with and find you the time that you need. There's a lot of news today I want to cover, and this is all coming out in the budget, what they're talking about. So next is actually an article from CNBC, and this gets into politics, but they're talking about another billionaire wealth tax. And so you have your pros and cons. The idea is to raise more revenue and for it to have people pay their fair share. And the super wealthy, billionaires tend to move. They're hypermobile, which means if someone gets taxed too much in one country, they can easily move to another and say bye, which has happened. Again, the wealthy, when you're going to tax them and punish them, they move. They go elsewhere. They move their assets. They stop investing. They go elsewhere. And so globally, this is only 3,000 individuals. And they're trying to focus on these wealthy individuals to bring in more money, have them pay their fair share, contribute to society, etc. The problem is when you do this, it frequently results in less funds to the government. So when the United States has increased their taxes, I'm going to do a quick share as well and just share some of the graphs here from this article. When you increase taxes, people move. People get out of Dodge. They don't always want to see it. So here I want to show this chart here. Wealth tax implementation. This is for democratic countries that are fairly advanced economically. Over time, number of countries that actually have a wealth tax has gone down, currently at 4. Why would it go down from 12 in the 90s down to 4 currently? Because countries lose money when they do this. Here's another chart showing what's happened. Revenues as a percent of wealth taxes. Now, Switzerland does have a wealth tax, but it's fairly low. Norway increased theirs in the 90s, and their revenues were stagnant or decreased. France and Spain both played with those, but it doesn't help, even though the tax rate is higher. If there are places for them to flee to, like Switzerland or other countries, and currently with only 4 countries having a wealth tax, there are plenty of places for the super wealthy to go. So again, the argument is that you want to address, you want income redistribution, you want to help the poorest the most, but ironically, when you attack the richest, they leave. So going right with this, another article, this one's from Newsmax, and this one's a little harsher. I don't know if I'm going to share this article, but it talks about the latest proposal in this current budget of increasing the corporate income tax rate from 21 to 28%. Again, the previous tax rate was 35%, and the Trump tax cuts cut it down to 21%. So what happened with the budget? Did we make more money or less money by cutting the tax rate? So the numbers went from around $297 billion in 2017 up to a projected $569 billion for 2024. So that's almost doubling it. I mean, it's anticipated to go down a little bit to $494 billion, but that's an increase of about a 70% increase. That's a lot of money. It's not chump change. So with our tax revenues going up, why is that? again, if we increase the corporate rate from 21 to 28%, you would expect that us to get even more money. However, the concern is when you tax corporations the most, they're competing with companies all across the world. And looking at the OECD world, market-oriented democracies, that would give us the second highest corporate tax rate in the world, well, in the OECD. So similar countries competing directly with us that still have free markets. So the concern is when you raise more taxes on corporations, first of all, the corporations don't pay it. They're entities, they're not people. It gets passed on to it lowers workers' wages, lowers investment. That's less money in people's 401ks, that are stockholders, shareholders. Overall, it hurts people's investments, and the real true cost gets passed around. But it's easy to say, hey, let's go after corporations, because there's not that many of them compared to the number of people voting, and it's an easy way to go after it. But the concern, and again, is to every action there's a reaction. And again, that's one of Newton's laws, and it's so true in economics. Anybody that tells you that there's a free lunch out there, that tells you that we can tax people with not having to worry about it, and I'm up against another break, so we'll be back shortly. Actually, I talked all the way through the last break. I didn't realize that. Fiscal policy, and so basically we went over that last article. I'm just going to summarize that. Was about the taxing corporations, and even though you tax them, you can get less income. There's less investment throughout the economy. Workers' wages go down. Corporations don't invest back into the new infrastructure, new equipment, updating machinery, so they're less efficient, and then they're less competitive in the global market. So it's kind of a lose-lose. Typically, it's a lose-lose proposition when you increase the corporate tax rate. And one of the biggest things, most of the profits go to shareholders in the form of 401ks, et cetera. So if we hurt the market overall by a corporate tax rate, it reduces the income of middle America that has these 401ks, has the IRAs that are investing, that are hoping to build a financial future off of investing in the marketplace. So there's no such thing as a free lunch. There's always a consequence to what people do. So again, if we have a free deal over here, greatest example is the ERC, one of the biggest newsletters. I didn't cite that article, I have it ready to go, but read an article recently where Congress is planning on saving a bunch of money, or the government, U.S. government, is going to save a bunch of money for the current budget, mainly by going after ERC recipients. So the employee retention credit, not only are they investigating for fraud, but this is driven by politics as well. If they can attack this hard enough and save enough money from it, they're using that to justify more expenditures elsewhere. And it's both parties that do it. That if someone thinks the Republicans are wholly to blame, or the Democrats are wholly to blame, again, it's both parties, in my opinion. Some are more to blame than others, but the Democrats will tax and spend in your face, and the Republicans tend to do it behind your back. So, a little jaded on that point. But as far as property taxes, and that's what we're really going to dive into the rest of the time, is talking about property taxes. And it's so true when it comes to property taxes. If you have lower property taxes, you have higher sales taxes. So again, it doesn't quite balance out. but one of the biggest factors here is government spending. There's no free lunch. Government does not make its own money. So if they're going to spend money, they got to take it from somebody. And the more they spend, the more they're taking from the individuals here. And so this is true, red states, blue states, doesn't matter. And we're going to kind of walk through this. And so what are property taxes? I'm just going to start from do the basics. So really it's a value, it's a tax that's based on the value of the property. So it's called an ad valorem tax, or that's a legal name for it, but it's based on the percentage of the value of the property. So for real estate, it's a percentage of whatever the county decides, or the county assessor decides that property is worth. And so these property taxes are done locally by counties, by cities. Again, so this is where being involved in local politics is very important. If you want to change local policies, you have to be involved in local politics. That's something that as a society, I think we've really gotten away from. Your average person usually doesn't have a clue who the local representatives are. I think I know who my county representative is. I know who the mayor is, but I'm not sure who's on the city council. Not too happy with or there's a post on Facebook this morning where people complain about which road is the worst here in Tucson. I live in Tucson, Arizona, and all kinds of people said this road is horrible, this road is horrible, this road. I'm like, well, nothing is going to change unless people get involved locally and there's some accountability. And like I said, it's both sides of the aisles. If you have Republicans in charge and there's no accountability, they run amok. Same thing if you have Democrats in charge and there's no accountability. They just get voted in election after election, and people just vote for whoever has an R or D next to their name. There's no accountability. So again, we have to be involved if you want to change what's going on locally. Property tax receipts are very important. They fund schools, police, fire departments, road construction and repair, libraries, water and sewer departments, and other local services. So here locally, I live on the outskirts of Tucson. There's a city right next to us that recently had an election to determine if they were going to incorporate or not. The biggest fear about incorporating is people don't want their property taxes to go up. So they're currently relying on the county, but if they create their own municipality, then they have to pay for the municipality, for a mayor or whoever's going to run it, and a city council, etc. And part of the plan is to have local services. Now I'm biased because I'm very involved in youth sports, have been for probably 2 decades now. So there's a lack of fields, there's a lack of facilities, there's no places. They use the high school fields or whatever school fields they can go to, and these fields get torn up really bad. So thus high schools reserve the best fields for their teams, and then they'll practice on the really bad fields. But then the youth teams, they're playing, you'd be surprised how bad these fields are. They're atrocious. You go to other areas in Tucson, the fields are actually pretty nice. They get taken care of. And you have some good, some worse. But where you have places that are incorporated throughout Tucson, you have decent fields, you have decent facilities, which kids need. Kids need a place to play. So this kind of strikes home for me. And it's all based on people willing to pay property taxes. So because it's whenever they're not willing to pay increased property taxes, but the housing is being built like crazy, the people are there, the kids are there, it just puts a squeeze on children and their ability to go out and have organized sports, recreational programs, etc. And the biggest problem is that there aren't fields available, or facilities or programs. So no city programs either, which I think is a travesty in my opinion. But again, if you want those kinds of services, you have to be willing to pay some property taxes or increase property taxes. Now, property taxes vary widely across the United States. They go from very little to very high property taxes. And it's paid either by individuals or corporations. So when corporations own property, they can have different rates depending on your county or city. So rates can be set based on whether you're an individual or a corporation, and that can also help minimize or reduce the amount of property taxes paid by individuals on their own homes. So property taxes in general are considered a regressive tax. So to compare that to what's called a progressive tax, regressive sounds bad, progressive sounds good. It depends. So for most progressive taxes, the idea behind it is that it taxes the wealthiest the most, that it hits the wealthiest the most. And like our income tax, for the poorer 50% pay almost nothing in taxes as far as income taxes. A very small percentage, whereas the richest 1% pay, well over 50% of the total taxes is collected. But when you have a regressive tax, it's the same for everybody. So the poorest are paying the same percentage as the wealthiest. Social Security, Medicare is an example of a regressive tax. And because it tapers off once you hit a certain income, it absolutely hits the poorest the hardest. That 14.9% that's taken out of your check if you're self-employed, or you're paying half of that if you are W-2, but your employer is paying the other half. So it makes it more expensive to employ people. So it's just keep in mind it's overall a regressive tax, and it hurts poor individuals just as much, if not more, than richer people. So unfortunately, a lot of times when tax rates spiral out of control for property taxes, it forces people out of homes. People that are on fixed incomes, people that have paid off their home, they've worked their whole life to get their home, and this is their retirement. All of a sudden, they can't afford the property taxes. So it's a tale as old as time. It's really sad when property taxes jump because it affects a lot of people. Now, quick differentiation here. Property taxes versus tangible personal property. I'm just going to touch on this real quick. Most places do charge taxes on tangible personal property, cars, boats, furniture, etc. And it's still property tax, whereas real estate taxes are just on land and structures, stuff permanently put on the land. So we're going to be focusing specifically on real estate taxes, which are typically called property taxes. Now, you'd be surprised by who has the lowest property tax. And again, it varies widely. In Hawaii, it can be as low as 0.29%, which is, and then Alabama, Colorado also have extremely low rates, but they usually have higher taxation or very low public spending, depending on where you are. So, so your local municipality or county will send out a tax assessor, evaluates the property with changing market values. When market values shoot up like they have been, property taxes can go up very quickly as well. And then whenever you get a new assessment, you have the right to formally contest the new rate. But when you don't pay property taxes, a lien is placed on your property. And if the property taxes, if it becomes an issue that's not resolved for too long, you can have your home foreclosed on and sold. So again, it's people lose property this way through property taxes all the time. It is pretty scary. It's frustrating, but again, especially when you have people on fixed income that are report that essentially get forced out of their home, it sounds like a real injustice. So, ironically, in California, you had I believe it's Prop 13 passed back. I think it was early 80s. Property taxes were shooting up so fast in the 70s. And again, you had stagflation going on. So you had very high inflation, but low growth. Because the inflation rate was so high, property taxes were shooting up with the home value increases. So whenever you have an economy that is not stable, high inflation hurts people all across the board, and it causes a lot of market distortions. That's why the Fed is trying to tamp down on our current high inflation rate. But again, there's going to be a lot of repercussions that are going to hurt people for a long time. And property taxes going up is just part of that. So back in the 70s, you had very high inflation. And so that's why some states reacted. In California, they passed Prop 13, which capped how much property taxes could go up every year. And so whenever you go and that's why people tend to hold on to property a lot longer in California, because the longer you're in it, the lower the property taxes. It makes a lot more sense to hold on to property and keep that low assessment. Whenever you purchase a new home, that's when property taxes start, and then it's can only increase so much per year after that. So whenever you buy new property, it has the reverse effect of making it so people are less likely to sell, which means there's less inventory, which means that property is not being used efficiently. But it's all because people don't want to sell, because then they have to pay this higher property taxes of owning new property. So it can decrease the inventory in the market. And again, is one of the drivers of why property is so expensive in California. One of the factors, not the main factor. So again, like to every action, there's a reaction. And it's so true when it comes to the economy. So you have some of the highest property taxes, Rockford, Illinois, Waterbury, Connecticut, Bridgeport, Connecticut, again, Aurora, Illinois, Eglin, Illinois, between 2.5% to 3%. So in general, states with high property taxes are Connecticut, New York, Illinois. New Jersey is another one where, again, the property taxes are very high. And then, so how do you address this? How do you understand what's going on? So to put this in perspective, there are 4 major reasons why or factors that affect property taxes. So if you have a heavy reliance on property taxes, just property tax, and you have a low to no sales tax or income tax, then your property value is going to be higher to offset that, because the local municipalities and counties, they still need money to run and to operate. Low home values usually mean that they charge more, a higher percentage, to generate a similar amount of income to operate a county or government. Higher local government spending is a huge factor. So you can get more public services, or it could be public waste that's going on. That's one of the big concerns in the Fannie Willis case. This is a little bit political, but this has been in the news. One of the biggest concerns is that all the money that's been paid by Fannie Willis prosecuting Trump, 600,000 plus has gone to Mr. Wade, who was a personal injury attorney and a family law attorney, now hired to take on a criminal RICO case. ask any attorney if this makes a sense. They'll tell you absolutely not. So one of the big problems with this deal, where she paid him so much and then taking huge vacations, benefited off of this, is that it's taxpayer funds being wasted, which drives up when they misspend funds. They have to have a balanced budget, so it drives up local taxes. You have to have higher property taxes, higher sales tax, et cetera, to spend or to account for this government waste or impropriety. And that's why it becomes such an issue. And, again, people are very upset about it. And there's a lot more into the politics of why people are upset, but that's why it's such a big deal as to what she's accused of doing with Mr. Wade. So, again, in some of the states with high property taxes, are the ones that have very low income taxes or low sales taxes. So Nevada has no income tax, but it's known to have high property taxes. Same with Texas. Florida, again, doesn't have any income tax, but their property taxes can be higher. So again, it really varies by what you're looking at. So again, this article, one of the main articles that I'm getting this is from the Lincoln Institute of Land Policy, and it has a comparison between a city in Connecticut, Bridgeport, Connecticut, and Birmingham, Alabama. So in Bridgeport, there's no sales or income tax, but the property taxes are really high. But in Birmingham, Alabama, they have sales and income taxes to local governments. So even though the property taxes are lower than Alabama, when you look at just the local taxes, the municipal taxes from Bridgeport and Birmingham, total taxes are higher, local taxes are higher in Birmingham, Alabama than Bridgeport, Connecticut. Now, they're not accounting for state taxes, which, again, the state tax in Connecticut is much higher than in Birmingham, Alabama, but that's how the local taxes can be very deceiving. Just because property taxes are low, you need to look at all the tax rates to decide what place is more affordable and better for your family in the long run. So again, it's can be misleading. So you have these 4 different factors, and whenever you have one, it offsets the other. So I'm going to share the screen again, and we just hit a break. So let's take a little break here. Welcome back. I apologize for getting too excited about property taxes today. You wouldn't think, if you told someone, hey, I listened to this great podcast about property taxes, most people would say, yawn, boring. But it affects, as you get older, you see the effects every day. And the effects on homeowners and individuals, on families. And building wealth generation is absolutely key to understanding property tax. So one of the terms this article uses, and again, we're going to jump back and just share some charts on that, so it gives us a better idea. And it's called property tax reliance. So when you have an over-reliance on local cities, property tax reliance, when they rely mostly on property taxes, they have low sales tax, low income tax, or they have high spending, that's when the property taxes tend to be higher, and the overall effect is felt more by individual homeowners. So we're going to go and look at some of these charts and kind of walk through this, and some of these will make sense. So again, this is from Lincoln Institute of Land Policy, and it's a 50-state property tax comparison study. So this is for 22. These numbers have changed. They have increased over the last couple of years. So some of the highest property states Detroit, why? 3.21%. Why is the tax rate so high? Main reason that they found was low property values. So in Detroit, if you understand what's happening in Detroit, Detroit has still not recovered. There are vast areas of Detroit that are still empty. And they, about 5 years, just under 10 years ago, about 8 to 10 years ago, Detroit was really kind of opened up to outside investors, and people went in and they bought all kinds of property, redeveloped property. Everybody thought this would be a big boom for Detroit. Unfortunately, a lot of these properties were just destroyed by renters that didn't care because there were no consequences. They couldn't evict people. The laws were so anti-landlord that people lost their shirts, they lost their money. People just came and squatted in residence. Oh, you just improved this and made it nice. Great, I'm going to come in and pay you for a couple months, and then I'm going to stop. And I'm going to squat here. Good luck getting me out in the next 9 months to a year. And so that there was some revitalization downtown, and they actually did improve downtown Detroit, but in a lot of the suburbs around it, these property values are in the toilet. And so that's why they have a higher rate for those. And New York, New Jersey, high property tax reliance, which means they don't have high sales tax. I know New Jersey, the state of New Jersey has a high income tax. But when you're talking about municipalities, because they don't get all that state money, they have to rely on property taxes with that they can control. And so that's why you get some of these really high property taxes where you have high public spending. Aurora, Illinois, again, high property tax reliance. They don't get the money from the state. Bridgeport, Connecticut, we talked about Bridgeport, Connecticut, high property tax reliance. And now people paying, when you look at the state, that's a factor that they didn't include in the study that I feel they should have to look at state taxes as an overall cost burden. Again, Connecticut has high taxes, but the municipalities don't get those funds, so they in turn rely on property taxes and charge a high rate. Portland, Oregon has a high tax rate. So again, like California has a limit, and so any newly built homes are going to bear the burden of those tax rates. Same in California. If you've been in your home 20, 30 years in California, your property taxes are very, very low. Now, looking at some of the lower tax rates, Salt Lake City has a low property tax reliance because they have the sales tax. They could even have an income tax. And then you're going to see what's typically here. They shift the cost to businesses. Now that can hurt areas where you have too much focus on shifting the cost to businesses. It can damage the economy. But again, here, low property tax reliance, they have other sources of income. You have classification, again, and high home values where you get more per home. You can usually charge less, a smaller percentage, and get more money. Boston, very low rate, high home values, and then the taxes are shifted to businesses. But again, Boston, Massachusetts has pretty high state income taxes. South Carolina, again, classification to business, and you have relatively high home values so they can afford to charge very low rates. And the lowest property tax is Honolulu, Hawaii, very high home values, low local government spending, and again, classification shifting the costs to businesses. So if you think you're paying too much where you are, get involved. You don't have to change your whole city's policies, but a lot of areas, the counties are setting these policies, and for sales tax, for other issues, and so it can help. So when you go towards much higher properties, again, more expensive properties, the numbers change. Chicago, again, high local government spending, shifting. You still have a shift of taxes to businesses, but you have a 4% rate for properties over on a commercial property. Detroit, very high, mainly because their property values are so low, so they charge a very high rate. to get this, a similar amount of funds to support the city and operate the city. Rhode Island, Connecticut, Des Moines, Iowa has a fairly high rate, low property values, and then again relying heavily on property taxes instead of other forms of taxes. So property taxes are just one slice of the puzzle here. Again, Honolulu, Seattle, Charlotte, Boise. Again, low government spending really helps to keep these taxes down. It's a big part of this. So again, that's something that can be controlled locally. Now, again, this talks about, we're going to kind of, apartment and commercial versus homestead properties. I'm going to kind of skip over this because we're running out of time. This is what you really want to look at. The effective tax rate. So the bill, for just on your median home, your average home for the largest city in each state, the tax bill might be low, but your effective tax rate is what you really want to look at. You want to look at this dark green line, which is why the percentages follow the dark green line, not the lighter green line. So the tax bill and then the effective tax rate based on everything around it it's what's going to be important here. So the ones with the light green have a much higher property tax bill, but then if you look at the effective tax rate, taking into account these other factors, it's much lower. But one thing they don't add into it is the sales or state income tax, which is the true cost of living in the area, and adds a huge proportion to that. So again, Detroit, New Jersey, Illinois, Connecticut, Oregon, Wisconsin, Maryland, Vermont. Then you get to Nebraska, Iowa, New Hampshire, Ohio, Texas. So you get some of these countries or counties, that you get them in red states too. So Houston, no state income tax, but it's up there as far as total effective tax rate for state and local taxes here, or city and local taxes here. So then you get some Florida in here, Anchorage, and then it kind of goes all the way down to Honolulu. So, and then commissioned property taxes in each state. This is for the largest city, again, Chicago, Detroit being the two highest by far. And what do you think this does to commercial development and investment in the state? It stymies it, and it hurts people in the end. And then it kind of tailors off to there. Now, one of the things I want to talk about here, kind of to wrap up, is some examples of where you have high property taxes that have really hurt people. And then a lot of it comes down to local policies. So Austin, Texas is an example of how things have gone wrong. So in the last 4 or 5 years, property taxes have gone through the roof. My own sister lived in Austin, Texas, so it's home. Average increase in Texas has been around 24% property taxes year over year. That is a huge increase. So they moved to Texas about 4 years ago, purchased a home. It wasn't a cheap home, I think it was around $400,000 to $500,000. Their property taxes went up so much that it increased their property tax bill by $1,000 a month. So again, huge impact. Priced them out of the market. They had to sell this home that they had only purchased a couple of years before, and then they moved to a cheaper state overall and bought a much cheaper home. They have a large family, so they needed a larger home. But it drove them out of the market, drove them completely out of the state. Now, Austin, it has a reputation now for having again, a lot of it, people moving from across the country to Texas, income states, less of a regulatory burden in Texas compared to California and New York. But at the same time, it drives up property taxes. And if you don't have local leaders that are willing to tackle this and ameliorate this issue, people get hurt. people's investments in homes and property, all this. I mean, she lost money. She lost a lot of money by buying and then selling in such a short amount of time before she could benefit from the increase in taxes, but she couldn't afford the home. They could afford it, and then when the property taxes jumped up, it just didn't make any sense for them. So when you're moving to an area, looking at effective tax rates, the total tax burden that you'll be paying is very important. Not for just the current situation, but what has the trajectory been, and what are the what's happening locally? Are they increasing property taxes? Are they trying to cap it and control it so it's reasonable? Here in Arizona, you have a lot of retirees. A lot of people that sell property, move to Arizona, buy something that they can afford, and they're living on pensions or Social Security. If you had huge increases in Arizona, you would force hundreds of thousands of people out of their homes. People that had planned their retirement, prepared for this, and all of a sudden they get forced out of their home and they have to move into a rental. They have to figure out something, usually at a much higher cost, because rentals have gone through the roof as well. So the policies driving property taxes, like you've got to look at all the different factors. And I really like that article, is that they said a lot of things matter. Local government spending. If a local government is overspending, it's going to drive those property taxes up. Sales tax, local sales tax, income tax, if it will offset it. But also, are they relying more on businesses or corporations? So this is all information that's very important to understand, and to understand what's happening with property taxes. Why are my property taxes going up? Should I expect them to increase? How can I prepare for that? And you could always negotiate with the local government regarding property taxes. You can always say, hey, can I get on a payment plan? Can I pay part of this? There are times where people have been able to settle, pay a part of it to settle the whole amount. That is rare, though. The reason for it is because it's attached to property. They can always foreclose on the property and take that money. So if you are going down that hole where you cannot afford the increasing property taxes, the option is to sell. Sell, rent it out, do something where you're making money off of that property. Otherwise, you will be forced to lose it if you continue to have property taxes that you can't afford to pay. And the frustrating part is sometimes it's homes that people have lived in, sometimes it's someone's retirement home. But again, in a changing economy, the more unstable the economy is, the harder it is to predict how to make wise financial decisions for you and your family. And when it comes to the heart of the matter, that's really what we're trying to do here, is help individuals get on their feet, stay on their feet, and for not only their current situation, but prepare for the future and set them on a path where they'll be successful long term. And property taxes are a huge part of that. Now, you'll get full credit for property taxes with the IRS. If you're paying on past due property taxes, you get full credit for that. It's a secured debt. It's secured to your home, secured to your property. But long term, you need them. I would highly suggest, if the property taxes are too high, take a hard look at it, discuss it with your family, make a decision as to what's best. What do you need to do with your property? Again, if you have any questions, give us a call at 520-485-7371, or contact us through guardiantaxlaw.com or through smartmoneyculture.tv. And thank you for watching live on rebroadcast. And I hope everybody has a wonderful weekend. You've got great weather, and that your family is safe and you're preparing for your financial future. And have a great weekend, everybody.